already experts on the standard deduction. But there is an additional standard deduction that we need to talk about. So there's an extra part. So they're talking here, eliminated the personal exemption, beginning with 2018. That's what I was talking about, that personal exemption. But what we have is a standard deduction. We always had standard deduction, but they increased the standard deduction amount when they eliminated the exemptions. But it kind of penalized larger families, because if you had, 5 people, 6 people, 7, 8, 9, you got a greater deduction from your taxable income with that exemption, and replacing it with a standard deduction that was twice as big really didn't make up for the loss for a lot of families, those larger families anyway. But what we have now is the standard deduction. You get a choice. So you can take the standard deduction, so that just that set amount of money subtracted from your total income that's based on your filing status. Standard deduction is based on filing status. You can take that, or you can take itemized deductions. There are different categories of itemized deductions. We're going to go through those in detail in chapter 5, what those are and the calculation of itemized deductions. In practice, what you would do is you would total up all of your itemized deductions and see which one is greater. You get whichever one is most beneficial. So the biggest one between those two is what you get to take. Now, for itemized deductions, just in general, are things like medical expenses, but there are limits to it. State and local income, or state and local taxes. This usually is like state income taxes that you've paid during the year, and property taxes that you've paid. So if you own a home, the property taxes that you pay on the home. Also, the portion of your automobile registration fees that are based on the value of your vehicle. That's usually what's in that category. Charitable contributions are another category, cash or non-cash charitable contributions. Mortgage interest that is paid, so if you have a mortgage on your home and you're paying interest, that is one category of itemized deduction. Couple others, miscellaneous items in there. So what you do is you total all of that up, and if it's greater than your standard deduction, you're going to take that. You're going to take that those itemized deductions, because you're going to get a better tax benefit. So at least they give you the better situation of the two. Most taxpayers take the standard deduction, especially since this Tax Cuts and Jobs Act of 2017, when that was passed, it significantly reduced the number of people taking itemized deductions, because it limited the itemized deductions quite significantly. So for most people, it was most beneficial to take the standard deduction. Now, the new tax law that was just passed, the OBBBA, One Big Beautiful Bill Act, I think it's 3 Bs, it remains to be seen what will happen, because they've actually made some of the itemized deductions more generous now. So there might be more people that take itemized deductions than would take the standard deduction. Also, each state has their own rules with regard to how they calculate income taxes. So there are some states where it still makes sense to itemize all of your deductions, and you might itemize on the state, but not itemize on the federal. Iowa used to be that way until they just changed the tax law. So we've had a lot of tax law changes over the last few years. Iowa had some rather significant changes, and prior to those changes that just took place, a lot of people would itemize on the state level, but they would take the standard deduction at the federal level, because the standard deduction for Iowa was really piddly. It was like, I don't know, $2,300, something like that. It was a ridiculous amount. But the higher the standard deduction, the more likely people will take the standard deduction rather than itemized deductions. So you get one or the other, not both. based on filing status, here's what it is for 2024. So for tax returns that were prepared last April, or if they're extended, they may still need to be prepared. This was the standard deduction. These are different for 2025, but for our purposes, we're working with 2024 numbers. Okay, so you should be familiar with those now that you've done a little bit of your homework and worked on those tax returns a little bit. You're probably familiar with what those are, but there is an additional standard deduction. So there's an amount that certain individuals receive if they qualify, if they meet qualifications. Taxpayers who are 65 or older, or who are blind, or both, can claim an additional standard deduction. I don't know why blind is given preferred status in the tax code as opposed to other disabilities, but for some reason it's blind. Deaf, no, that you're not getting any special treatment if you're deaf, only if you're blind. I guess the lobbying must be out of this world for that. But anyway, so if you're 65 or older or you're blind, you can claim an additional standard deduction over and above these amounts. So that additional standard deduction, again, depends on filing status. And like I said, if you're both over 65 and legally blind, you get to stack them on top of each other. So if you're single, then you get an additional standard deduction of $1,950. So let's do some math here. There it is. Okay, so let's just say we've got somebody who is single and they are 65. That means they would take single 1460, I'm sorry, 14,600, and then they would get to add another 1950. So their full standard deduction is 16,550. So they get that additional standard deduction. Now, what if we're married filing jointly? Might as well erase all of it. So let's say we're married filing jointly. So our standard deduction is 29,200. Got that right? Yeah, 29,200. One spouse is 65. Spouse 1 is 65. Spouse 2 is 64. Spouse 1 gets an additional $1,550. Spouse 2 gets nothing. Full standard deduction is $30,750. So let's change that a little bit. Let's say spouse 2 is 66. They each get an additional $1,550. I got a calculator up here now. Whoops. Stop. Except I have fat fingers. $32,300. All right. Well, let's say spouse 1 is blind and is 65. Spouse 2, not blind. Spouse 1 is going to get another $1,550. Spouse 2, nothing. $33,850 is going to be the standard deduction. So for each spouse, you get to determine, do they get one or both of those additional standard deductions. If both of them were blind, then another $1,550 is added. So for each of these factors, an additional $1,550 is added. $35,400. Say now, if you're head of household, obviously only one person, this only applies to the taxpayer. This does not apply to any dependents on the return. Any other people. Your name has to be up at the top of the return. You guys have filled out returns now. You know that section where the names are, there's only space for 2. So this only applies to the individual or individuals that are listed at the top of the return. None of the dependents that are listed down below. Okay? So if we've got somebody who is, let's say we've got head of household, and they are 66 years old. So we start with the standard deduction for head of household, $21,900. And then we're going to add, for head of household, we get an additional $1,950. Not $1,550, $1,950. So for single and head of household, they get more of a bump, right? So now they're up to $23,850. Does that make sense? I get a lot of questions on this, by the way. I get a lot of students who are confused about this, so that's why I'm kind of trying to go through slowly. But what you have to do, like I said, so this person, if they were also blind, what would happen? They get another $1,950. Right. Exactly. No questions about that? Okay. So they got Flora is 56, single, blind. She has a standard deduction. We're going to start with the regular standard deduction, and then because she's single and blind, she's under 65, but she's blind. So that's one of the factors. She gets an additional $1,950 added to it. So $14,600 plus $1,950. If she was 70, she'd get $1,950 times 2 added to that standard deduction. They got Pedro and Marie married. They got a 19-year-old dependent child who is blind. Pedro and Marie are entitled to a standard deduction of $29,200. That's it. Nothing additional for the dependent. It's only for the taxpayers. Okay? Standard deduction can be 0 if married couple is filing separate returns and one spouse itemizes. Then both spouses have to itemize. The reason for that, let me show you. So we've got spouse 1 and spouse 2. If both, so let's say both hit the standard. This is married filing separate. If both take the standard deduction, they both get $14,600, $14,600. You add those two together, you come up with $29,200. That's the same as the married filing jointly. If you have married filing separate and one is taking the standard deduction, but one is itemizing, let's say spouse 1 is taking the standard deduction, so $14,600, but they're going to put all the deductions, all the itemized deductions on this spouse's return. Say they're, what, $30,000 $30,000 worth of itemized deductions for all of it. Now, you're getting a lot more than that standard deduction. So you're getting what, $44,600. Can't do that. So if, again, one takes a standard deduction, one itemizes, now this spouse has to take a 0 standard deduction. This spouse can take the 30. That's fine, and they get the 30 of itemized deductions. Actually, if they were married filing jointly, they'd probably take the 30 anyway, because it's more than the $29,200. But what it does is it eliminates them doubling up. Because if they were married filing jointly, they'd only get that one, they get a choice, standard or itemized, right? And their limit would be the $30,000. But if they're allowed to do standard and itemized, they get $44,600 together. So that's why you cannot, if you're married filing separately, that's one of the limitations of that filing status. Married filing separately, if one spouse itemizes, the other spouse itemizes. The only way you take the standard deduction is if both spouses take the standard deduction. If a taxpayer is a non-resident alien, you do not get a standard deduction. We're not going to do anything with non-resident alien returns. They are an absolute nightmare to prepare. We don't do anything with those. If a taxpayer files a return for a period of less than 12 months because of a change in accounting period, I can't think of any situation where that would be the case for an individual tax return. Every individual has a January to December tax year. You don't choose any other tax year as an individual. Corporations can have different tax years. Individuals cannot. So I don't know of any situation. When a taxpayer can be claimed as a dependent on the return of another individual. So it's entirely possible, and happens all the time, where you have a child who is a dependent, like they're still a dependent on their parents' tax return, but they made enough money that they have to file their own tax return as well. That money doesn't get put on the parents' tax return. The only money that shows up on a tax return is the income from those two people at the top. Any income from any of the dependents elsewhere on the return, they're going to get their own tax return. So again, same thing. Only those people at the top, it's their income and deductions. Okay? So it's possible for a child to have a separate job, like a summer job or a job after school, that sort of thing, and they've made enough money that they have to file a tax return. And they have to file a tax return separately from their parents. But they are a dependent of their parents. That means they don't get to claim themselves as a dependent. Remember, dependents can only be on one tax return. They can only show up on one tax return to get that benefit. So when a taxpayer can be claimed as a dependent on the tax return of another individual, the basic standard deduction changes. I think you do have homework problems, or at least one homework problem around this topic. So it's going to be the greater of, whichever is greater, $1,300, or the taxpayer's earned income plus $450. So earned income is from, if it was subject to Social Security and Medicare tax, it's earned income. That could be self-employment income. Usually it's wages. Anything that shows up on a W-2 is going to be earned income. Interest income is not earned income. That's passive income. You didn't work for it. Your money worked for, the money worked for you rather than you working for the money. Dividend income as well is passive income. That's not earned income. Anything that you earned through your efforts is earned income. So what you would do is take the earned income plus $450, and that's your standard deduction. So essentially what that means is only unearned income is going to be taxable to you. So again, this is mostly from like kids with summer jobs, with after-school jobs. Maybe they're in college as well, but they're dependent on somebody else's return. If you look next time you're looking at your tax return problems or your Tax Act problems, there's a question there about can you be claimed as a dependent on somebody else's return. There's a yes or no question right at the front, right on page 1 of the 1040. That's what it's pertaining to. Is if that is the case, if the answer is yes, then you have a different standard deduction. And it's either going to be $1,300 or your earned income plus $450. Let's see, what else? So Congress enacted that to prevent taxpayers from shifting income to their children or other dependents. So for example, a couple could give a child a bond that pays interest of $3,500 a year. Without the rule, the entire $3,500 of interest income would be tax-free, but because this basic standard deduction for any filing status exceeds that amount, with the rule, the standard deduction for the child would be $1,300. Because they didn't have any, it's to prevent passive income from being transferred to children, right, as a way of tax planning. In this example, the child doesn't have any earned income. So it would be the greater of $1,300 or $450, so it would be $1,300 is their standard deduction, which means the child's gonna pay tax on, yeah.
I'm sorry, but can you explain it again?
Explain the
part where it's, like the taxpayer can be claimed as a dependent.
Mm-hmm.
Yeah, can you just explain that part?
Sure, so this usually happens, like I said, with parents who have high school or college age kids who are still dependents on their return, but that child has a job. Okay, so say they're working at Fairway and they earned enough during the year so that they have to file a tax return. So within that standard deduction is kind of an assumption of dependency as well, or within the amount of that standard deduction. But so that you can't double up on the benefit. Like the child can't get the benefit of the full standard deduction and the parent gets the benefit of the full standard deduction. Kind of like with the married filing separately thing. So in those cases, a child has to, when they're filing a tax return, they have to say on their tax return, they have to answer that question, yes, where it says, can you be claimed as a dependent on somebody else's tax return? The answer is yes. A lot of those kids, like when I would get those, well, most times what happens is the parent is a client and then they come and they bring the kid's return as well. So it's really easy to know that they are dependent on somebody else's return, but sometimes you just get the kid coming in and they have no idea. Like, I don't know. And so they've got to call mom and dad and ask them and all this. 9 times out of 10, they are still being claimed as a dependent because that's the most tax advantageous position for the parents. But so this happens, like I said, when the child has to claim or has to file a tax return. And which means they have enough income that they're gonna have a tax liability, right? But they are already a dependent on their parents' return. So their name is showing up on that dependent area of their parents' return, but they've gotta file their own return. So it just changes, then their deduction is reduced. Does that
that makes more sense.
help at all? Okay. Any other questions? Right. So here's an example again. Sherry's parents can claim her as a dependent on their tax return. In 2024, her only source of income was from a part-time job at a store. She earned $2,500 during the year. Her standard deduction is $2,950, which is going to be the greater of $2,500 plus $450. Her earned income there, plus $450. Now, in reality, Sherry's probably not gonna bother with filing that tax return unless she's owed a refund. That's usually when these kids will file their tax returns, is because they had some money withheld from their paycheck and they wanna get it back. And maybe it's more money than what they're gonna have to pay an accountant to file the tax return for them. So maybe they had $300 withheld, and they gotta pay an accountant $150 to prepare the return. I don't know where you'd find somebody to do it for $150 these days, but, so they're gonna net $150 out of that, so they go ahead and file the return. In 2024, Joji received $1,425 of interest income. The interest was his only source of income. So his standard deduction is gonna be $1,300, which is the greater of $1,300, or earned income, which they said was 0, plus $450. So whichever one is greater of those two. The whole purpose behind this is to reduce income shifting, passive income shifting from parents to children. Why would they do that? Because the children are at a lower tax rate, right? If your child is at a 10% tax rate and you're at a 24% tax rate, and you can shift $10,000 of passive income to your child, well, now you're gonna pay $1,000 of tax on that as opposed to $2,400 of tax on that. So that's where that comes in to play. And usually it's gonna be wealthier people that do that, and it's gonna be more than $10,000 because they can receive significant tax savings. But this is designed to reduce that. Yeah.
I have a question.
Mm-hmm.
So are we saying if you could be claimed on your parents' tax return, then as a child, your standard deduction is gonna be $1,300?
It's going to be whichever is greater, $1,300, or your earned income plus $450. So if you got $10,000 of earned income as a child, you worked at Fairway, then your standard deduction is gonna be $10,450, because that's larger than $1,300. So remember, it's gonna be the larger of the two, either $1,300 or the earned income plus $450. So the earned income I shouldn't say it can't be transferred. It can if the parents have a business, then there are ways to transfer it. But this is designed, like I said, its focus is on reducing the transfer of passive income to your children. But it's gonna be, so you'll just compare. Which is bigger, $1,300 or whatever that earned income is, just the earned income, plus $450. That's gonna be the standard deduction. Okay, does that answer your question?
Yes.
Okay. Let's see, I already did that. We kind of did that to death. All right.